Welcome, curious minds. You've officially dropped into the deep dive. We're the show that slices through complex topics to find those surprising facts and insights that, really make you feel well informed.
Yeah, it's all about getting you those essential nuggets of knowledge, fast but thorough, so you
Mhm.
can connect the dots, have those real aha moments.
And today, we are really diving deep. We're heading into the, let's say, fascinating world of financial reporting for not for profit organizations. We'll look at how their unique accounting rules are different from, say, a regular business or even government entities.
hmm
Our mission: demystify the numbers, show you what really matters when you look at these financial statements.
So we've pulled together some great source material to guide us. So yeah, let's unpack this financial landscape piece by piece, make sure it's all easy to grasp.
Okay, so let's kick things off. What exactly is a not-for-profit according to FASB? It's got to be more than just not trying to make money, right?
Oh, absolutely. It's much more specific. The sources point to three uh, core characteristics. First, most of their revenues come from contributions. Think donations.
Okay.
Second, their operating purpose isn't primarily about making a profit. Now, they can generate a profit, that's not forbidden, but it can't be distributed to owners like in a business.
Right. No dividends.
Exactly.
Yeah.
And third, their ownership interests are totally different from businesses. No shareholders expecting a return in that sense.
Okay, so this isn't just like small local charities we're talking about. What kinds of organizations actually use this not-for-profit accounting? Give us a feel for the scale here.
Oh, the scope is huge, much broader than people often think. It generally falls into four big categories. You've got healthcare organizations,
Right.
hospitals, nursing homes, hospices, that sort of thing.
Makes sense.
Then educational institutions, colleges, universities, private schools, voluntary health and welfare organizations. Think United Way, American Red Cross, March of Dimes, big names.
Mm,
And finally, this big catch-all, other private not-for-profit organizations. This covers everything from cemetery organizations, fraternal groups, to museums, libraries, performing arts groups,
yeah.
even professional bodies like the AICPA.
Wow, okay, that covers a lot of ground. So, given this diversity, who actually uses these financial statements? And what are they looking for?
Good question. The main users, donors, obviously, members if it's a membership organization, creditors if they lend money, and even governments providing grants. And they mostly share common needs. They want to assess basically three things. What services does the organization provide? Can it keep providing those services?
Sustainability, yeah.
Exactly. And really importantly, how well are the managers doing their job? Are they using the resources wisely? That's stewardship.
Stewardship. Okay, so to give users that info, what key things must the financial statements show?
Well, they absolutely have to show the organization's financial health. So it's assets, liabilities, and net assets. That's your statement of financial position.
Balance sheet equivalent.
Right. Then they need to show the effects of events that change those net assets, the inflows and outflows of resources, and how those really, that's all on the statement of activities.
Okay.
Then how cash comes in and goes out, the statement of cash flows. And finally, some info about the organization's service efforts. You might find that in the statement of activities or more often detailed in the notes.
Is there a specific accounting method they have to use?
Yes, JAP requires them to use the full accrual basis of accounting.
Okay, full accrual.
But what's really interesting here, and different from businesses, is the main focus isn't calculating net income for the period. Instead, the emphasis is on transparency, showing where the resources came from and how they were spent to achieve the mission. It's about the organization as a whole, even if they use fund accounting internally for management. The external reports consolidate everything.
Okay, let's get into the nitty-gritty. The statement of financial position, you said it's like a balance sheet. What are the core parts?
Yeah, but just like a commercial balance sheet,
Yeah.
fundamentally. You've got assets, liabilities, and then net assets, which is similar to equity. Assets and liabilities are classified, usually current and non-current, and sequenced based on, how close they are to cash or when they're due.
Okay, standard stuff there. But here's where it gets really NFP specific, and I think where people get confused. Net assets with and without donor restrictions. What is the crucial difference? Why does this matter so much?
This is the fundamental distinction for NFPs. It's all about whether a donor, an external party, has put specific limits on how assets can be used. So net assets without donor restrictions. These are funds available for general operations. The governing board can decide how to spend them.
So totally flexible funds.
Basically, yes. And here's a key point. If the board itself decides to set aside some of these unrestricted funds, say, for a future building project, they call that board designated,
Uh-huh.
Those funds are still classified as without donor restrictions. Why? Because the board can change its mind. It's an internal decision, not an external restriction.
Ah, okay. That's a common mistake. Right. Thinking board designated means restricted.
Very common. It can really skew your view of the NFP's flexibility if you misunderstand that. Then you have net assets with donor restrictions. These are subject to specific limits imposed by the donor.
Okay.
Examples: money given specifically for one program, funds that have to be invested for 5 years, donations that can only be used next year, money given only to buy equipment, or endowment funds where you can only spend the income, not the original gift. The donor calls the shots.
So donors can get really specific. What kind of detail, what disclosures do NFPs need to provide about all these restrictions?
They need to give qualitative info descriptions. How do they manage their cash for general expenses within a year, considering these limits? They need to describe the types of restrictions, the amounts involved, any contractual limits, and importantly, how and when those restricted resources can actually be used.
And quantitative, too.
Yes, quantitative info on their liquid resources, showing how those external donor limits and internal board designations affect what's truly available.
The source material has a good example note for net assets with donor restrictions. It lists things like subject to expenditure for specified purpose, like program alpha or buying equipment, then subject to the passage of time, or subject to spending policies like for endowments, even subject to appropriation when a specified event occurs, and not subject to appropriation like land that just has to be kept as a park. It really shows the range.
Exactly. And like we said, there's usually a supplemental disclosure for the without donor restrictions part 2, showing those internal board designations like a quasi-endowment the board created or liquidity reserve.
Right.
It just further clarifies what's an internal choice versus an external mandate. And when you look at a sample statement of financial position, you see those two categories, with and without restrictions, clearly adding up to the total net assets. It looks quite different from a business balance sheet.
Definitely. Okay, let's shift gears to the statement of activities. This sounds like an NFP's income statement and maybe statement of retained earnings rolled into one. What does it have to show?
Yeah, that's a good way to think about it. It shows the changes over a period. It absolutely must present 3 key things: the overall change in total net assets, the change specifically in net assets without donor restrictions, and the change specifically in net assets with donor restrictions.
Okay, breaking down the changes, how are revenues and gains classified here? Does it follow that same restriction logic?
Precisely. It all hinges on donor restrictions again. Revenues are reported as increases in net assets without donor restrictions if they're, say, fees from services, contributions that came with no strings attached, or investment income that wasn't restricted by the donor.
Pretty straightforward.
Then you have increases in net assets with donor restrictions. This is where you see that donor-restricted support. Contributions for specific programs or capital projects, funds restricted by time, or those permanent endowment gifts.
What happens when a restriction is met, like the time passes or the money's spent on the right program? Is there some kind of accounting entry?
Yes, that's a really key process called reclassification. When a donor restriction is satisfied, you report a reclassification on the statement of activities. It shows up as a simultaneous increase in one net asset class, usually without donor restrictions, and a decrease in the other with donor restrictions.
Ah, so it moves from restricted to unrestricted.
Exactly. For example, if a clinic gets a state grant restricted to, say, vaccinations, once they provide those vaccinations, they can reclassify that grant money from with restrictions to without restrictions in that same year. They just need to disclose the policy.
But not for permanent endowments, right? Those restrictions don't expire.
Generally, no. Perpetually restricted assets usually aren't reclassified because the core restriction, keeping the principal intact, never ends.
Makes sense. How are expenses shown on this statement?
Okay, expenses. With the exception of investment expenses, which are usually netted against investment return, all other expenses are reported as decreases in net assets without donor restrictions.
Always without restriction.
Always without donor restrictions. And they're categorized in 2 main ways. Program services, these are the costs of activities directly related to the mission. Education, research, patient care, whatever the NFP does. And support services. This is everything else: fundraising costs, management, and general administrative expenses, membership development, overhead, essentially.
And they have to report these expenses by both nature and function. What does that actually mean, and why is that detail useful?
Right. This is a really important disclosure for transparency. Functional classifications are those program and support categories we just mentioned, like the cost of the youth arts program versus the cost of fundraising.
Okay.
Natural classifications describe what the money was spent on: salaries, rent, utilities, depreciation, supplies, like your general ledger accounts.
Yeah.
The NFPs must show the relationship between these two. They can do it on the face of the statement of activities, put it in the notes, or have a whole separate statement, often called the statement of functional expenses. The source has a great example table. It shows expenses broken down by function: program alpha, program beta, management, fundraising. And then across the rows are the natural expenses: salaries, grants, supplies, depreciation.
Ah, I see. So you can see exactly how much salary cost went into program alpha versus management.
Exactly. And why is this useful? It gives users a direct look at efficiency. How much is going into the actual mission versus administration or fundraising? It lets you really assess that stewardship piece we talked about. Are they using resources effectively?
Very clear. Okay, moving beyond the main statements, let's talk statement of cash flows. Is it pretty much the same as for businesses, or are there NFP quirks?
Largely similar. Same three sections: operating, investing, financing. And they can use either the direct or indirect method for operating activities.
Okay, but there are quirks.
Oh yeah, there are some crucial NFP-specific classifications for certain cash flows that can definitely catch you off guard if you're used to commercial accounting.
Okay, hit me with some key examples. Where do things get classified differently?
All right, operating activities. This includes the usual stuff like general receipts and payments, insurance proceeds, unless tied to investing, contributions received, and disbursements made. But here's a tricky one. Cash received from unrestricted resources, even if the board internally designates it for buying long-lived assets, still goes in operating.
That board designation thing again. Doesn't make it investing or financing just because the board earmarked it?
Exactly. Board intent doesn't change the source classification for cash flow. Investing activities are pretty standard: buying or selling PP&E, selling artwork, making or collecting loans. Financing activities include issuing debt, repaying debt. But here's the big NFP difference. Financing also includes cash received from contributions that are specifically restricted by the donor for long-term purposes, like contributions restricted for acquiring buildings or equipment, or contributions restricted to establish or increase a donor-restricted endowment fund. That donor restriction makes it a financing inflow for NFPs.
That is a critical difference. Donor-restricted gifts for long-term assets are financing, not operating.
Precisely. It highlights the external control aspect.
What about non-cash stuff? Like getting a donation of stock?
Good point. Non-cash investing and financing activities need to be disclosed, but separately, not on the cash flow statement itself. Examples are contributed securities, construction in progress that's still in accounts payable, getting beneficial interests in trusts, non-cash debt refinancing. You list them in the notes.
Okay. And one more cash flow question. If an NFP uses the direct method for operating cash flows, do they still have to provide that reconciliation from change in net assets back to cash from operations like businesses do?
Here's another fascinating difference. No, they don't.
Really?
Yep. NFPs using the direct method are not required to provide that reconciliation. It's a significant departure from commercial GAAP.
Why is that?
It really goes back to their unique reporting focus. The emphasis isn't on reconciling to a bottom-line profit figure like net income. It's more about showing the actual cash inflows and outflows related to operations and mission delivery. It respects their different structure and purpose.
Interesting. So the sample cash flow statement would start the indirect reconciliation, if used, with change in net assets, right?
Correct. If they use the indirect method, they start with change in net assets and make adjustments for non-cash items like depreciation, gains, losses, etc., just like a business, before getting to the investing and financing sections. And the notes would clarify if restricted cash is included in the total cash balance shown.
Okay, let's tackle revenue recognition. For NFPs, is it basically all about contributions, or are there other major types?
Contributions are huge, obviously, but they also have exchange transactions. These are basically earned revenues, where the NFP provides a service and gets paid for it.
Like tuition fees.
Exactly. Student tuition, patient service revenue in a hospital, membership fees for an association, those are exchange transactions. And crucially, revenue from exchange transactions always increases net assets without donor restrictions. It's earned income.
Got it. Now let's dive deeper into contributions. What's the official definition, and when are they recognized?
Okay, a contribution is defined as an unconditional, voluntary, non-reciprocal transfer of cash or other assets. Unconditional is key. Unconditional contributions are recognized as revenue, or sometimes gains, if they're incidental when they're received or pledged unconditionally.
You emphasized unconditional, so there must be conditional contributions. What are those, and why wait to recognize them?
Yes, exactly. A conditional promise or contribution depends on some future uncertain event happening first.
Yeah.
You don't recognize revenue until those conditions are substantially met.
What counts as a condition?
Conditions usually involve barriers. Things like having to achieve a specific level of service, produce a certain output, meet a matching requirement, or maybe depends on an outside event occurring. And importantly, the donor must have the right to get their money back if the condition isn't met.
So it's not just a restriction on how to use the money, but a barrier to getting it in the first place.
Precisely. If an NFP gets money up front for a conditional promise, they record it as a liability, a refundable advance, not as revenue.
Okay, that distinction is critical then. Conditions are like hurdles you have to clear to get the funds, while donor restrictions are rules about how you use funds you already have entitlement to. That's a great aha moment.
That's a perfect way to put it.
What about promises to give or pledges? Someone says they'll donate later.
Right. Unconditional promises to give are recorded at their fair value when the promise is made.
Even if the cash isn't received yet.
Yes. If it's a multi-year pledge, you record it at the net present value. And because it's receivable over time, it's automatically considered donor restricted due to the time restriction. And another nuance. When you collect payments on a multi-year pledge, the difference between the discounted amount you initially recorded and the actual cash collected is treated as additional contribution revenue, not interest income.
Interesting. What if pledges go bad? Someone promises money but never pays. Is that bad debt expense?
Another NFP twist. You do set up an allowance for uncollectible pledges, just like in a business. However, you don't record bad debt expense.
No bad debt expense. So what happens?
Instead, both the pledge receivable asset and the related contribution revenue are reported net of the allowance. You essentially reduce the initially recognized revenue. The source shows a calculation. Gross pledges minus the allowance equals the net pledges receivable reported.
Okay, net reporting, not an expense. Got it. What's this placed in service approach for donated long-lived assets?
Right. If an NFP receives a long-lived asset, like a building, and there are no specific donor restrictions on its use, they have to use the placed in service approach. This means if the building is ready for use immediately, the NFP recognizes the entire fair value of the building as contribution revenue without donor restrictions right away.
Wow, the whole value up front.
Yes. But if the donor did restrict its use, say, it must be used as a homeless shelter for 10 years, then it's initially recorded as donor restricted support. As the restriction is met over time, often recognized alongside depreciation, portions are reclassified from with restrictions to without restrictions. It shows how donor intent dramatically changes the timing of recognition.
Let's take donated services. This always seems tricky. My sense is they're usually not recorded, right?
You're generally right. It's often hard to value them reliably. However, they must be recorded as both contribution revenue and an expense at fair value if they meet specific criteria. Either one. They create or enhance a non-financial asset, like volunteer construction workers building an addition. Or two, they require specialized skills, were provided by individuals possessing those skills, and the organization would typically have needed to purchase those services if they hadn't been donated.
Specialized skills, like
Yeah.
a lawyer, accountant, doctor.
Exactly. If a lawyer provides pro bono legal services that the NFP would otherwise have paid for, that gets recorded.
So if a professional plumber fixes the pipes for free, and we would have paid a plumber anyway, that's recorded as an expense and contribution without restrictions.
Precisely.
But if someone volunteers to answer phones, and maybe we wouldn't have budgeted for a receptionist, that might not be recognized.
Correct. The key is specialized skills, or asset enhancement, and otherwise purchased. Just general volunteering, while valuable, often doesn't meet the criteria for formal recognition in the financials. But remember, any costs incurred to recruit volunteers are always fundraising expenses.
Okay. How about donated collection items, art for a museum, historical items?
These have specific rules. They are not required to be recorded if three conditions are met. 1, they're held for public exhibition, education, or research. 2, they're protected, kept unencumbered, cared for, and preserved. And 3, the organization has a policy that requires proceeds from any sales of collection items to be used to acquire other items for the collection or for its direct care.
So if they meet all three, they can choose not to record them.
Correct. But if any of those aren't met, they must be recognized as assets and revenue support.
And just regular donated materials or gifts in kind like stock.
Donated materials, if significant, are recorded at fair value as assets and contribution support when received. Think donated food for a food bank. If it's just stuff passing through like used clothing drives where the NFP is just a conduit, it might not be recorded unless substantial. Gifts in kind like donations of stock or bonds are definitely recognized at fair value when received. If the NFP sells that stock later for more than its value when received, say as part of a fundraiser, that excess amount is treated as an additional contribution.
Any special display for these non-cash gifts?
Yes. Non-financial assets received as donations have to be presented as a separate line item on the statement of activities, and there needs to be disclosure about their valuation, disposition, and any donor restrictions.
Okay, let's touch on fundraising. If an NFP gives you, say, a tote bag for your donation, how does that work?
The cost of that tote bag is a fundraising expense for the NFP, and the amount of contribution revenue they recognize is the total amount you donated minus the fair value of the tote bag you received.
So they only record the purely charitable part as revenue.
Exactly. It avoids overstating the contribution.
Finally, are there any really unique revenue rules for specific NFP industries, like universities or hospitals?
Oh, definitely. Educational institutions. Student tuition and fees are reported at the gross amount. Scholarships or tuition waivers they grant are treated either as expenses or as a direct reduction of that gross revenue, not netted beforehand.
Okay, gross reporting for tuition. What about healthcare?
Healthcare has several unique points. Patient service revenue is recorded on the accrual basis at established rates. But charity care services provided where there was never an expectation of payment is not recognized as revenue or a receivable at all. It's not bad debt either. They just have to disclose their policy for providing it.
So it just disappears from revenue?
Essentially, yes, it's excluded from the start. Then they make deductions from gross patient revenue for things like contractual adjustments with insurers or discounts they offer. Bad debt in healthcare is tricky. If it relates to amounts they expected to collect based on screening the patient but couldn't, it's treated as an operating expense.
Okay, like normal bad debt.
But if the bad debt results from large volumes of revenue where they didn't assess the patient's ability to pay upfront, think emergency room visits, then it's treated as a deduction from revenue, similar to a contractual adjustment.
Wow, that's a subtle but important difference in treatment.
Very. It reflects the different circumstances of providing care. They also have things like capitation revenues, fixed payments per member per month from HMOs, that's patient service revenue too.
Yeah.
Other operating revenue might include things like hospital cafeteria sales or tuition from a nursing school run by the hospital. And non-operating revenue includes the usual investment income, unrestricted gifts, but also, interestingly, donated services that meet the criteria we discussed earlier often fall into non-operating revenue for healthcare entities.
Okay, so far we've been deep in the world of private not-for-profits governed by FASB. But you mentioned earlier that governmental entities, public universities, city hospitals, the city itself, they play by a whole different set of rules. What drives their accounting and why is it so different?
Yeah, it's a really important distinction. While both NFPs and governments serve the public, their fundamental accountability objectives are different. Governmental accounting, set by GASB, is all about demonstrating stewardship of public resources, taxpayer money, primarily, and proving compliance with laws, regulations, and budgets.
Public money, legal compliance.
Yeah.
Okay.
This focus leads directly to fund accounting, which is absolutely foundational for governments. It allows them to track and report on different pots of money that are legally restricted for specific purposes.
So who exactly uses this governmental accounting? Just like Washington, D.C.?
Oh no, much broader. Federal, state, counties, cities, towns, but also entities that are run by governments. That could include some public hospitals, public universities, public libraries, etc.
So a private university uses FASB NFP rules, but a state university uses GASB governmental rules.
Exactly. That's the key distinction. It's not just the type of service, educate and healthcare, but the entity's control and funding base. Is it governmental or private? That determines whether FASB or GASB applies.
Okay, FASB for private NFPs, GASB Governmental Accounting Standards Board for governments. Got it. What's the overarching goal for GASB reporting?
Accountability. That is the absolute cornerstone. Governmental financial reports exist to allow citizens and elected officials to hold the government accountable, to justify why resources were raised, taxes, and show how they were actually used. A key concept within this is interperiod equity. The idea is that the current generation citizens should pay for the services they receive in the current year. Governments should live within their means each year, not burdening future taxpayers for past services.
Trying not to kick the can down the road. Makes sense. Are there specific qualities these government reports should have? You mentioned a mnemonic.
Yes. To achieve that accountability, GASB emphasizes reports should be URMICE. Understandable, reliable, make a difference, that's a relevance. In timeliness, consistent year over year, and entity-to-entity comparability.
URMICE.
Got it. Okay, so how do governments structure their actual accounting to meet this need for accountability and track all these different legal restrictions? You mentioned funds. Right. It revolves around three core themes: fund structure, fund accounting, and external reporting. Let's start with fund structure. GASB defines 11 specific fund types, but they fall into three main categories. First, governmental funds. These are used to account for the basic government services. Think police, fire, administration, parks. The mnemonic often used is GRAS-DP.
GRAS-PP.
Yeah. General funds, special revenue funds, debt service funds, capital projects funds, and permanent funds. These funds focus on current financial resources, tracking cash and other assets that can be spent soon. Their balance sheets generally only show current assets and current liabilities. No long-term assets or long-term debt related to these general government activities.
Okay, GRAS-PP for basic services, focusing short-term. What's next?
Second, proprietary funds. Think SE. These account for a government's business-type activities, where they charge fees for services, very similar to commercial accounting. Service, internal funds, which serve other government departments, like a central motor pool, and enterprise funds, which serve external customers, like a city-owned water utility or electric company. These use full accrual accounting.
Got it. Business-like activities. And the third type?
Third are fiduciary funds. Think CIPPOE. These account for assets the government holds as a trustee or agent for others, individuals, private organizations, or even other governments. The money isn't the government's to use for its own programs.
CIPOE.
Custodial funds, investment trust funds, private purpose trust funds, and pension and other employee benefit trust funds. Think of the city managing the employee pensions plan assets. They're acting as a fiduciary. These also use full accrual.
Okay, GRAS-PP, SE, CIPPOE, governmental proprietary fiduciary. Now this gets complex. Measurement focus versus basis of accounting. Can you break those down and link them to the fund types?
Absolutely. This is crucial but can be tricky. Let's take them one by one. Measurement focus asks, what items are being measured and reported on the financial statements, particularly the balance sheet? For governmental funds, GRAS-PP, the measurement focus is current financial resources. This means they only report current assets and current liabilities related to those assets. They focus on the near-term flow of spendable resources. It answers, what expendable resources do we have right now and what claims are against them?
Okay, short-term view for GRAS-PP.
Right. But for proprietary funds, SC, fiduciary funds, CIPPOE, and the government-wide financial statements, which consolidate everything, the measurement focus is economic resources. This is like regular business accounting, all assets, current and long-term like buildings, and all liabilities, current and long-term like bonds, are reported. It gives a long-term view of financial position.
Economic resources, everything. Current financial resources, just current stuff. Got it. Now, basis of accounting, that's about when things get recorded, right?
Exactly. Basis of accounting determines when revenues and expenses, or expenditures for governmental funds, are recognized. Governmental funds, GRAS-PPP, use the modified accrual basis. This is unique to government. Revenues are recognized when they become both measurable AD available. Available means collected in the current period or soon enough after, usually 60 days, to pay current period bills.
So revenue recognition is tied to near-term collectability.
Yes. And expenditures, that's the term used instead of expenses here, are generally recorded when the liability is incurred, except for things like principal and interest on long-term debt, which are typically recognized when they are due. It lines up spending with the budget year.
Okay, modified accrual for GRAS-PP and the others.
Proprietary funds, ZTE fiduciary funds, CIPPOE, and the government-wide financial statements all use the full accrual basis. Just like businesses and NFPs, revenues are recognized when earned, expenses are recognized when incurred, regardless of cash flow timing. This gives that longer-term economic picture.
So if I piece this together, the GRAS-PP funds use modified accrual and focus on current financial resources. But the SE and CIPPOE, plus the overall government-wide statements, use full accrual and focus on economic resources. Is that right?
You've got it perfectly. That's the fundamental split. The individual governmental funds give that short-term, budget-focused view using modified accrual. The proprietary, fiduciary, and government-wide statements give the longer-term, more business-like view using full accrual. It's clear that while NFPs and governments might both aim for public good, their financial reporting is built on truly different foundations.
Wow, what an incredible deep dive. We've really navigated the unique financial reporting waters of not-for-profit organizations today, covered their core definitions, the crucial difference between net assets with and without donor restrictions, and all those tricky revenue recognition rules for contributions and donated services.
Yeah, and then we took that important detour into governmental accounting, highlighting its bedrock principle of accountability, that concept of interperiod equity, and how its whole fund structure and those different measurement focuses and bases of accounting really set it apart.
So now, hopefully, you've got a much more solid foundation for looking at the financials of anything from, that local charity down the street to a major university or even your city government's reports.
Definitely. And maybe here's something to think about next time you see an annual report from an NFP or a government entity. How does their main funding source, donations versus taxes, seem to influence what information they emphasize? And based on what we discuss, what deeper questions might you ask now to really gauge their accountability and how well they're managing the resources they've been given?
Great question to ponder. Stay curious, everyone. Keep learning, and join us next time for another deep dive.